There's been a big increase in the number of homes for sale in Canada. Last month, the total number of properties on the market rose 6.5%, the second fastest monthly gain we've ever seen. And experts say it's because home buyer demand has been dented amid stubbornly high interest rates. But in Toronto's luxury market, where prices started around $4 million, sales have been steadily rising. For more on the numbers, we're joined in studio by Paul Maranger. He's a broker with Sotheby's International Realty in Canada. Thanks very much for stopping by.
Oh, good morning, John. Thank you for having me.
So obviously there's all sorts of categories within real estate, but when it comes to the luxury category, which is your specialty area, what have you been seeing recently?
Well, in Toronto, we defined luxury in terms of housing as $4 million and above, condominiums at $3 million and above. There has been decent demand this past quarter in the $4 million price range. However, there's been a flight to quality. So people are looking for top addresses, top condition, turnkey, fully renovated or new construction.
And $4 million, as sticker shock as that might be for some folks, the reality in a city like Toronto is it wouldn't necessarily get you as much as it would have some years ago as well. When I mentioned the broader theme that we're seeing in the housing market right now is across the country, you've got more homes on the market and people are testing the waters in the spring season, and the higher interest rate environment maybe has changed how quickly buyers move. Can you walk us through a little bit more of that dynamic that you're seeing in the luxury market?
Absolutely. Yeah. So buyers at all segments of the market have some pause. They have the luxury of time now. There's no rush to make a decision. So with higher interest rates, they're proceeding with their purchase. There's an expectation, I think, market-wide amongst buyers that rates will fall. And buyers, I think, en masse will engage when rates will fall. However, now buyers are engaging, and they're the only ones at the offer table. It is a more civilized approach to the negotiations, and buyers aren't in a particular rush to make a decision.
And Paul, in the luxury market in a city like Toronto, prices can go like how high are we talking? $10 million bucks?
So the luxury market would be defined as between 4 and 10, and the uber luxury market over 10.
Okay.
That market is flat over $10 million. There's very little activity occurring. That is predominantly due to the foreign buyer ban. With the introduction of the foreign buyer ban and the extension of the ban, we don't anticipate the over $10 million segment to improve until that foreign buyer ban has been lifted.
Interesting. And then on the interest rate issue itself, because it has felt like in this unique economy, we've heard about a lot of luxury brands that are still doing relatively well. You're in many cases talking about a buying class that is less susceptible to the ups and downs of interest rates. Do you see some of that in pockets of the luxury housing market?
That's an excellent comment. There's a misconception that the luxury segment is not impacted by interest rates.
Okay.
A lot of people who own luxury homes own businesses. They own cottages, they own ski chalets, they have investment portfolios that they leverage their primary residence in Greater Toronto or whatever city they live in to purchase those additional assets. So in fact, they are interest rate sensitive, but maybe perhaps for other reasons that $1 million buyer might be interest rate sensitive. So definitely the luxury segment is interest rate sensitive.
Interesting. And then in terms of the kinds of properties that are catching the eye of buyers right now, you talked about some of the specifics around that. What are the kinds of deals that are getting done right now?
That's a great question. We're seeing two ends of the spectrum. So on one end is picture perfect, magazine quality, renovated or brand new.
Right.
Sells very well because people are time starved. They are working 60 hours a week at the office. They're busy with their families and their kids. They don't have time to undertake a renovation. The corollary to that is the other end of the spectrum, value-oriented buyers that are buying the fixer-uppers. Those also are doing well. It's the houses that are in the middle that are half renovated. Those are more problematic to sell. The demand seems to be at the two ends of the spectrum. Fully renovated, fully turnkey, move-in ready, or homes that need a complete renovation.
And I just wanted to circle back on what you were saying before, sort of the the connective tissue of the luxury buyer who might have all sorts of other properties as well. A lot of people have been talking about the capital gains tax changes. Has that come up in conversations with any possible home buyers or home sellers recently? Is that a consideration that's creating some buzz these days?
Oh, absolutely. However, our asset class, real estate as an asset class, is not as liquid as perhaps a stock portfolio. So in order to liquidate a real estate asset, it's probably, let's say, 4 months on average. So nothing has occurred in terms of the June 25th deadline. It's just too fast. But what we're seeing is people are having conversations. They're having conversations with their lawyers, with their tax advisors, with their realtors and other professionals. It's causing conversations in families, but it's too quick for people to react in the real estate sector.
All right.